What's up, everyone? It's Scotty with MoneyVest. So markets here obviously rallying quite aggressively on Friday with the NASDAQ up over 2%, S&P 500 pushing up over 1%. So we got lots to unpack in this video, and we also do have a lot of earnings coming out, including the likes of Amazon and Apple, and of course along with a lot of other S&P 500 constituents. So as always, if you enjoy this video and find it helpful, make sure that you drop a like, and don't forget to subscribe to the channel if you're just joining us for the first time. And links to our Discord and Patreon is going to be down below. There's a few more spots left until the end of April 2024. So that 16% annual discount is available until the end of this month. And of course, you do get access to all the members-only private videos, including our very special 30 stock shopping list, including all the buy targets, aggressive buys, light buys, as well as our MoneyVest index, which the success rate after the back testing has been very, very strong at over 90% win rate for that MoneyVest index. The interesting thing is that it's not going to be a frequent indicator, meaning that it's not going to be giving us a buy signal as frequently. But when it does, the probability of success is going to be very, very high. So it's really going to give you the high quality risk reward setups in the markets when the timing is actually correct, when the timing is suggesting for a very good risk reward ratio. Also, do connect with me on Instagram. My handle is going to be CastWRP. Would love to connect with you there. And I do post a lot of interesting stories. Again, some a little bit personal and also professional, just, portfolio updates, P&Ls, everything's going to be down below as well. So would love to have you on board. So this right here is the earnings season that is coming up for next week, starting with SoFi on Monday, and that's going to be pre-market. We got One Semi, Domino's, we got Philips, all reporting pre-market. We got Paramount, NXP, another really big semiconductor stock here. Logitech are all reporting on Monday after the bell. Tuesday is going to be a pretty big day because we do have one of the big tech companies like Amazon. AMD is going to be reporting. Supermicro, we got Starbucks all reporting after the markets close. And pre-market, of course, we got our very own beloved PayPal, Eli Lilly, we got 3M, we got McDonald's, we got Coca-Cola. A lot of really, really important consumer discretionary stocks are reporting. And then Wednesday pre-market, we got Pfizer, CVS, so some of those health pharmaceutical companies, along with MasterCard, Norwegian Cruise Lines, Kraft Heinz is reporting pre-market as well. And after the markets close, we got Qualcomm, we got Paycom, we got Carvana, XLS Technologies, Fastly, and Etsy also reporting. Thursday, we've got one of the very top stocks out of Denmark, Novo Nordisk. We've got Canadian Natural, we got Peloton, Moderna reporting pre-market. We got Cigna and Wayfair also scheduled for earnings pre-market. And then Thursday after the bell, we got Apple, of course, one of the largest companies in the world. Coinbase, we got Block, we got DraftKings, we got Cloudflare, we got Fortinet, we got Amgen, and we got Booking Holdings and Expedia as well. And then Friday, before the markets open, we got Hershey, Fubo TV, we got XPO Logistics, and that pretty much wraps up the earnings week for these companies. So a lot of really, really important companies and a lot of S&P 500 constituents reporting their numbers. This right here was a Friday, so very, very strong rally on the day. So S&P 500, of course, pushing up a little bit over 1%, so back up to over 5,000, so just almost under 5,100. The NASDAQ, on the other hand, pushing up over 2%, 15,900. So of course, we're going to take a look at some of those technical levels that we identified in our previous videos. We definitely did see a nice breakout on the NASDAQ here, which we will come back to. And of course, not to mention the higher highs and potentially higher lows forming now on the NASDAQ and S&P 500 also, with a very nice jump of potential higher highs over here that we are now starting to form. Again, we'll discuss that later in the video. So Google pushing up almost 10%, Amazon up 3.5%, Nvidia up over 6%, Microsoft's up almost 2%. Of course, Broadcom, AMD, Oracle, Adobe, a lot of stocks, mostly the technology sector, pushing higher very, very nicely. And this right here, again, is the entire market. And in the last 1 week, so last 1 week, of course, Google 11.5%, Nvidia up over 15%, Apple up 2.6%, Amazon up 2.8%. Meta is the one that's actually struggled in the last 1 week because of earnings, and Microsoft up over 1.8%. So a lot of money has kind of flown back into technology and semiconductor stocks more specifically. Intel was down over 6.7%, but TSMC, Broadcom, we got AMD, Texas Instruments, Micron, Qualcomm, ARM Technologies, everything pushing higher, 4, 5, 6, 7, 8%. in the last 1 week. This right here is still the last 1 month, and what you'll notice is we still have a lot of red. So all of technology is pretty much red, along with semiconductors. Communication services with Meta and some other telecom services also down. Google is perhaps the only stock that is up over 14% among big tech. Amazon slightly flat basically. Apple's been down over 2.3% in the last 1 month. And we do have a lot of financials. We do have a lot of auto manufacturers, including industrials and even basic materials. All sectors down, with healthcare also struggling in the last 1 month, with consumer defensives basically flat. So it's really just been energy and Google stock that's been pushing higher in the last 1 month here in the markets. So this is going to be, again, the daily performance. So you can see comm services and technologies kind of leading the way. Utilities was red in the last 1 week. All sectors are green, all 11 S&P 500 sectors. And in the last 1 month, again, real estate, healthcare, technologies kind of selling off quite aggressively. And it's only comm services because of Google. And of course, energy, as I mentioned earlier, the two sectors that are pushing higher. Oil prices, Nikkei 225, Euro Stocks 50, NASDAQ, DAX, copper prices pushing higher with volatility selling off. Natural gas, lean hogs, and palladium also selling off here. Bitcoin just over 63,500 and Ether just under 3,300 as well. Now this right here, another really negative headline coming in. Stock market crash. Chart shows the S&P 500 could be set to fall 50%. Now these are the type of headlines that can create a lot of fear, uncertainty, and doubt. And I really want you to kind of disregard a lot of these types of predictions, because nobody really knows. At the end of the day, nobody has any idea what the markets are going to do. Yes, there are some charts. Yes, there are some macroeconomic factors. We can create our own narrative in our story. But at the end of the day, nobody really has any idea where the markets are going to go. So this right here is from John Wolfenbarger, the founder of Bull and Bear Profits, and a former investment banker at JP Morgan and Merrill Lynch, says a recession is still on the way and the outlook is bleaker if you look beneath the surface. And in an interview with Business Insider on Friday, Wolfenbarger said one of the ways the labor market is weaker than it looks is the kind of jobs that are being added. The number of full-time employees is actually declining, and it's starting to look like a trend, the same that has happened at the start of prior recessions as well. And he also did point to the idea that a large percentage of jobs being added over the last year have also been from non-cyclical sectors like healthcare, government, and education. These areas of the economy are generally insulated from downturns as well. So this right here is really where majority of the job creation activity is happening, apart from like construction, manufacturing, and to some extent, I mean, he does have a point. I mean, it's really just construction and manufacturing. Those are the main key drivers of any economy. So if you're not adding any jobs in manufacturing or construction, I mean, that is concerning, but at the same time, it is still on a net basis positive, right? So the only time I would start getting concerned is if we are losing jobs in the manufacturing sector or construction sector or mining or lodging sector here. That's when I would start to feel a little bit more concerned about the economic sort of condition, and more specifically unemployment. At the same time, inflation has been sticky, hanging above 3% year over year, and this forcing the Fed to keep monetary policy tight to prevent another flare-up in price growth. And John said the longer the Fed keeps rates restrictive, the longer it puts pressure on the labor market and broader economy, raising recession risks as well. The next 1 to 3 months of job reports, I think we could start to see declines, and typically job declines start kicking in about 2 years after the Fed rate hikes start, and they started in March of 2022. So basically what he's suggesting is that now is the time when those higher interest rates are going to start affecting the US economy and of course unemployment. And as a result, in the next 2-3 months, we're going to start seeing some declines in unemployment, meaning job gains are going to start to decline and unemployment is going to start increasing here. These risks are being reflected in the Conference Board's leading economic index, which has a perfect track record of identifying recessions, and the index takes into account variables like bond and stock market activity, manufacturing activity, consumer confidence, and lending activity as well. And in addition to higher valuations, the inverted yield curve is another one reason John has been such a dire outlook for the stock market going forward, and the length of the inversion has historically been related to how deep the subsequent recessionary bear market has been. And the current inversion duration about 550 days, roughly the same amount of time seen before the 2008 recession, puts the S&P at risk of a 60% sell-off. Quite insane. And the longer the curve stays inverted as the Fed keeps rates elevated, the bigger the downside potential. So one of the things that I want to point out to is the entire thesis is built on the idea that there is going to be a recession. If there is no recession, economy and earnings continue to be super strong. And I think that's pretty obvious, right? We've talked about this before on the channel. If there is a recession, yes, earnings are going to take a hit. Yes, unemployment is going to be higher. Yes, the Federal Reserve would need to pivot to a more quantitative easing strategy in order to help support growth and really just stimulate growth once again. So the entire thesis for a market crash at the very core is built on the idea that there is going to be a recession along the lines in the next 2 to 3 months here, or perhaps by the end of 2024. If there is no recession, like I said, the economy and the earnings continue to be strong, and we can expect the markets to be much better and much stronger. This right here, again, S&P 500 drawdowns based on the duration, the 10-year minus 3-month yield curve inversion takes place. And the longer it stays that way, so 1929, it was 700 days plus that this yield curve remained inverted. This right here is 2008, so 500 plus days that it remained inverted. And also in 1974, it was around the 500 days mark. And right now we are somewhere around here because we have just spent 550 days of that inversion, and that is going to basically result in a 55 to a 65% crash in the S&P 500, because that's really what the average has been in the last couple times we have witnessed something like this. But again, both of these times, the market entered the R word. The economy entered the R word, meaning there was a recession, there was a pretty significant depression over here in 1929. So both times we actually experienced pretty significant high levels of unemployment. And of course, the economic growth was very, very troublesome, which resulted in a significant drawdown in the S&P 500. So really the idea is, do you believe there is going to be a recession, right? So let me ask you this question. Pause this video and answer if you actually believe there's going to be a recession. If yes, then there is a possibility that yes, the S&P 500 is lower 6 months, 12 months later, and that is only going to create a buying opportunity for most investors. But if you believe that there is not going to be a recession, if you believe that the economic growth is so strong, economy is strong enough to handle higher interest rates for longer, unemployment is not going to go higher, then there is really no possibility for a recession. If you believe, then the markets are going to be much stronger and more stable than in an environment where we go into a recession. So it really comes down to the R word and whether we're going to see that or not in the economy. Me personally, I have seen the economy be super strong, but I'm still not going to give into this idea that higher interest rates can't affect the economy eventually. I do believe if interest rates stay higher for longer, there's going to be some cracks in the economy. We're going to start to see unemployment going higher if interest rates stay higher for longer. So if inflation doesn't come down fast enough, there is a possibility that the Federal Reserve has to raise interest rates or keep them higher for longer, which is in turn going to affect the economy eventually, which obviously is going to affect they're going to keep the interest rates higher for longer, which is going to affect the economy, which is going to affect, of course, unemployment, and then the recession follows, and then S&P 500 also sees that potential drawdown. So it's kind of like a chain event, but like I said, it really just comes down to inflation. I think that's really what we have to watch at the moment. So this right here was the PCE, personal consumption expenditure, the Fed's preferred measure of inflation, and you'll notice that we actually came in line and somewhat hotter than what the expectations were. So PCE index on a year-over-year basis at 2.7% compared to 2.6%, and then of course month over month we were at 0.3% for personal consumption expenditure, right? So PCE, of course, coming in month over month, 0.3%, year over year, 2.7%. GDP for the first quarter coming in slightly lower, so 1.6% compared to 2.3% expected. And personal consumption expenditure on an annual rate basis came in at 2.5% versus 2.8% for the economy for the first quarter. So this right here is the S&P 500, as we have already discussed. And we did gap up as expected. So I did an update on Thursday. I mentioned that we are going to gap up here because we're up 1% pre-market on the back of very strong earnings from Google and some other companies. So we did gap up here very nicely. I did mention that, this is going to be turned into a support, which it did very, very nicely. And we did push higher intraday. You'll notice that we did rally back up, but the interesting thing is that we weren't able to break out above 5110 to 5112 levels, right? So this is a very, very important level of resistance. 3 times, in fact, we got rejected on the 5-minute chart, as you can already see. So this right here was the level that we identified on Thursday during that market update that, yes, we're going to gap up, but this is a huge resistance to watch on the S&P 500. So this is exactly the level to keep in mind going into Monday. And support level is going to stay put at 5,080 to as much as 5,100 for the S&P 500 as well. Talking about the NASDAQ, same exact thing. So we talked about how there is going to be a potential for a breakout. So this right here, we kind of gapped up and then we rallied even further, which is very good. So we're going to go ahead and turn this level into a support on the NASDAQ right now at 15,900, which is very, very solid. And that's exactly what we wanted to see for a potential for a trend reversal on the NASDAQ here. So very nice move to the upside. And now we're just going to be watching this level, 15,900 as a support. And the next target, next resistance to watch out for the NASDAQ is going to be sitting roughly over here at 16,000 pretty much. So 16,000 is going to be that next threshold for the NASDAQ to break out of. So boom, right there, previous resistance, boom, another resistance, and then that in turn became a support for the NASDAQ a couple times. So 16,000 is going to be that level to watch, and the good thing is that we are making some higher highs, so boom, boom, and we are making some higher lows over here as well. So that is, again, showing some signs of positivity in terms of that potential uptrend. Same thing for the S&P, boom, boom, some higher highs, and boom, boom, some higher lows for the S&P as well. So again, we're making progress, we're moving in the right direction, and next week's earnings are really going to dictate whether we see higher highs and breakouts beyond 5110 on the S&P, and of course break out over 16,000 on the NASDAQ, or if you get rejected and of course rotate back lower down to those support levels. Talking a little bit about Apple now, so moving over to individual stocks. So first of all, let's just quickly go over volatility. So VIX here trading at 15. So coming back down 4 or 5 consecutive days of red. It's been coming down from highs of 21, 22. So very nicely rolling over. And the next target again is going to be down at 12 all the way down to 11 and 10 levels, which is going to push the markets higher, potentially back up to all-time highs. But if the VIX does spike again, that means we're getting a rejection on the S&P and the NASDAQ, and we're back headed lower. But really, I mean, it's just when the VIX is high, it is time to buy. I did pick up some Tesla, I did pick up some Apple, did pick up some VUG and SMH when the VIX was higher, but it wasn't high enough for me to be dollar cost averaging quite aggressively. So again, patience is what's going to play out eventually. And that's really what the key is to long-term success. That the prices come to you. When we get the VIX spike, the prices do drop 4 or 5%. That's a good opportunity to buy. It's a good risk reward. So we did buy. I did send out some alerts. But again, keeping some dry powder heavy here on the sidelines in case the markets drop further, so we can dollar cost average more and we can be a little bit more aggressive when the volatility is even higher and the markets are even lower. So coming back over to crude oil, lots of consolidation sideways, so we're kind of bouncing off of that support here at $80, $81 a barrel. So next resistance and target is going to be at $87, $80 a barrel. So that is going to be that next level to keep in mind, and a very, very massive support at around $80, $81 per barrel here for crude oil. So that is going to be that level to keep in mind for crude. Coming over to Apple, so very nice bounce back higher, so pushing up a little bit from that support. So really just a lot of consolidation, still very oversold. We've seen a lot of accumulation, I would say, from L3 banker oscillators, so lots of yellow candles. So whales continue to buy, in my opinion. They're continuing to kind of see this as an opportunity to accumulate more and more Apple here, and the next target and resistance is going to stay roughly at 196 to 199 for Apple, with a much stronger support at that second tier 2 in the 150s for Apple as well. Talking about Amazon, and Amazon here also bouncing higher once again, so up over 3.4 very, very nicely, and support level is going to stay put at this higher low for Amazon. So getting a bounce back higher, resistance and target's going to stay put at 188 for Amazon as well. Talking about Tesla, and Tesla here, very nice bounce from those earnings. So it has recovered a little bit over 21, 22%. Next resistance and target's going to stay put at 177. It's still struggling to break out over those levels. So that is going to be a target and a resistance level to keep in mind. And a support level is going to stay put in the 150s for Tesla, kind of aligned inside this green rectangle for the stock here. Still very much trading inside this downtrending channel of lower highs and lower lows. And then, of course, another support level, another lower high and lower low pattern for Tesla here. So this right here has been another downtrending channel of lower highs and lower lows. So it really does need to break out over 177 in order for us to see some potential for that recovery back up to 200s for Tesla. Talking about Nvidia here, and Nvidia doing really well, breaking out from this downtrending channel of lower highs and lower lows. And the next resistance and target is going to stay put at $909 per share. So this right here is going to be that next level to keep in mind for Nvidia. And of course, support level is now going to be turned back into $845. So that is going to be that support. Resistance back up to $907 per share for Nvidia. Talking about advanced micro devices and AMD here, also seeing a very nice bounce. I do believe that AMD is one of those companies that has a very good swing trading opportunity potential here because of how oversold it is, because of how much it's been selling off, and it's pretty much trading at a very nice support at around 146, and the next target and resistance is going to be at 164 all the way up to 183. So I will be sharing a trade idea on AMD for all the members, for next week. So that is going to be shared in our Discord under the Trade Ideas channel. You can join with that 16% annual discount. Link's going to be down below. But the target right now is going to be 164 all the way up to 183 for advanced micro devices. Talking about PayPal, and PayPal on the day also pushing higher, up almost 3%. So not bad. And the next target and resistance is going to stay put at $68. We're seeing some momentum back higher from the RSI. MACD also on the verge of crossing over that signal line again. And the L3 banker oscillator also showing some signs of that momentum back higher. But we do also have this double top resistance that we're dealing with. So massive resistance where we have gotten rejected in the past at $68, $69. So if we do break out above this level, then there is potential for us to retrace back up to $76, $77 per share. So that is going to be that next target and that next level to watch for PayPal. Talking about Visa, and Visa also seeing a lot of consolidation after breaking down from its all-time highs of 290, dropped about 7 to 8%, really just consolidating sideways now. Support level is going to stay put at 265 at the moment, resistance and targets back up to 290 at the moment. But in my opinion, I think Visa is a little bit more of an expensive stock, and I would wait for it to come down to better prices before dollar cost averaging or buying. Visa is also, by the way, part of our 30 stock shopping list. Meta, on the other hand, had a huge gap down after the earnings, of course, bought up intraday as we talked about it, and resistance and target's going to be around 450 to 475. So this right here inside this red rectangle, very, very important level of resistance to watch for Meta, and a support level is going to stay put at $385 per share for Meta as well. So resistance and targets back up to 515 for this company. Netflix, on the other hand, also seeing a lot of consolidation. So it actually gapped down pretty heavily, and support level is going to stay put at 536. Resistance and targets back up to 596 to $600, all the way up to 636 for Netflix. And again, we're seeing a lot of consolidation with a very massive support at 536 for Netflix. Google, all-time highs, breaking out very, very nicely, up almost 10%. Huge gap to fill on the downside. There's not really much that we can go over apart from the fact that it's overbought right now. Massive momentum. Just be super careful considering the valuation is expensive for Google now. Market cap sitting at well over $2.1 trillion. So just over $200 billion added in market cap for Google in just one single day. So lots of influx of capital into Google, and massive support sitting roughly in the 160s down in the 150s for this company. Talking about Microsoft, and Microsoft here selling off intraday after the earnings, of course, rallied a little bit, but of course selling off intraday, and support level is going to stay put roughly in the 397, 395 range. Resistance is going to stay put at 417 for Microsoft as well. It doesn't quite look like a head and shoulders, but I mean, this right here could be labeled as a left shoulder. This could be looked at as a head and then potential right shoulder with a neckline here. So I don't know. We'll see how it kind of progresses over the next few days to a few weeks. And support level is going to stay put at 397, 398. Nphase, on the other hand, also seeing a little bit of a rally, 3.8%, 111.93. Support level is going to stay put at 106, 107. Resistance and targets still up to 138. We got a double top resistance. We're not able to break out above this resistance here for Nphase, and one could even argue that we are making some lower highs at the moment as well as some lower lows. So this right here could be seen as a bit of a downtrending channel for Nphase as well, with a very nice support sitting roughly at $92 per share for Nphase. And then finally we got Costco. And Costco on the day was also pushing higher, up over 3.8%. So a lot of consolidation in that range. So really what we have here for Costco is consolidation. Resistance is going to stay put roughly over here at 747 to 750, and a massive support at $703 per share. So again, of course, we'll see how it ends up trading, but in my opinion, again, Costco is a little bit more of an expensive stock. Valuation's a little bit up there, so I wouldn't personally be touching Costco here at these prices. So hope you all enjoyed this video and a complete update on the markets. The bottom line is that yes, there is a possibility for a bigger market sell-off, a bigger correction or a bear market or even a full-blown crash, but that is only dependent on the potential for a recession or not. And that is dependent in turn on whether inflation comes down fast enough or not, because at the end of the day, interest rates are really what's going to dictate how the market's performed, how consumers spend, what the earnings look like. So all of that is going to be very much of a probability sort of outcome and scenarios that we have to discuss. But the bottom line is be prepared for everything. If the markets are giving you opportunities, if they are selling off 4, 5, 7, 8%, take those opportunities as we already discussed. Have cash ready to be a buyer in the market when the markets are selling off, because that is a very good opportunity and the risk reward is only getting better as the volatility is higher and the markets are selling off. So hope you all enjoyed this video and find it helpful. Make sure that you drop a like and don't forget to subscribe to the channel if you're just joining us for the first time. And again, links to our Discord and Patreon is going to be down below. Don't forget to subscribe. With that 16% annual discount, you will have access to all the members only private videos, and also do connect with me on Instagram. My handle is going to be CASWRP. As always, happy investing, and I'll see you all in the next video.